This is Macro Horizons, episode 282, Doneflation, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery and Vail Hartman to bring you our thoughts from the trading desk for the upcoming week of July 15th. And please keep in mind that this year's institutional investor survey is still underway, and we'd truly appreciate your support and a 5-star rating in the categories of U.S. rates, technical analysis, fixed income, and short duration. Tipping is optional, but encouraged. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, there were 3 developments that really defined trading in the Treasury market. First was a solid round of auctions from the Treasury Department. Second was Powell's semi-annual congressional testimony. And third, and by far the most relevant, was the weaker-than-expected core CPI print for the month of June. Now, core CPI printed at just 0.065% in June, and on an unrounded basis, that's compared to 0.163 in May. So while technically it's a 0.1 versus a 0.2, it was both a low 0.1 and a low 0.2. This offers further confirmation of the disinflationary trend resuming and suggests that monetary policy has finally started to catch up with the real economy, and the path towards a September rate cut has become far more reasonable to envision. This is precisely what the futures market is pricing in, with better than 80% odds that the Fed cuts in September. Now, keep in mind, there will be 2 additional inflation prints between now and the September 18th meeting, but if the general trajectory remains in place, the Fed will use the opportunity to begin normalizing rates lower. Within the details of the release, what we see is that the supercore measure, which is core services ex shelter, came in at 0.1 versus being 0 in May. This is well below the 0.6 and 0.7 levels that we were seeing at the beginning of the year, and is undoubtedly a welcome development from the perspective of monetary policymakers. We also started to see some more reasonable prints from rent, which was up 0.3%, but a low 0.3 on rounded 0.261, and OER 0.3 on rounded 0.267. So this is consistent with what the market, ourselves included, was generally expecting would occur on the housing front. Some of the acute upward pressure has been alleviated, and as housing inflation returns to more normalized levels, as we have seen in June, that will drag down the overall core figures. It's also important to keep in mind that in the month of June, headline CPI disappointed, printing down 0.1%, as opposed to being up 0.1% as anticipated, and versus being flat in May. This brought the yearly pace down to 3.0% compared to the 3.3% level in May. Overall, the inflation update conformed with Powell's signaling that the Fed is going to be taking a more balanced approach to its dual mandates. And with that backdrop, the disappointing private payrolls growth seen in June becomes all the more relevant, and we suspect will leave the market more biased toward dip buying during the summer months. It's also worth highlighting that we are entering the time of the year when the seasonal patterns have historically favored a drift lower in rates, on average in the 10-year sector worth 35 to 40 basis points.
June's inflation figures suggest the U.S. economy is truly getting back on a disinflationary track that would leave the Fed in a position to begin cutting policy rates on September 18th, assuming the next 2 months of inflation figures fall into the good data category as defined by the committee. Specifically, June's 0.065% core CPI gain was the lowest in 3.5 years, and this brought the annual rate down to 3.3% and the lowest since April 2021. Now, putting June's pace in the context of the Bloomberg survey of economists, the downside surprise was surely a shock to a market, given that the survey showed 77% of the estimates in the 0.2% range, and only 6% of economists showing a 0.1% gain, and 17% forecasting an upside surprise at 0.3%.
It certainly was a shock to the market that core CPI was as moderate as it was, and we did see that reflected in the price action. The front end of the market rallied. 2-year yields got below 450, which was a pivotal level. And one of the more surprising aspects of the price action from our perspective is that the yield curve didn't break out steeper. 2s, 10s maintained a level below negative 30 basis points. Now, to some extent, with 2-year yields at effectively 450, investors are signaling that what they're expecting is a fine-tuning series of rate cuts as opposed to a quick return back to neutral and potentially below. What remains to be seen is how the market responds in September, assuming we actually do get the first rate cut, combined with an updated SEP and dot plot for 2025 and 2026. All else being equal, we think that the market is poised to begin the process of re-steepening into positive territory, and certainly the events of the last week and a half have confirmed that the yield peaks are in for this cycle.
And as has been the case really throughout the bulk of the last 18 months, the market environment has been one of trading data point to data point. Part of that has to do with the Fed's emphasis on data dependence, and part of it has to do with the evolution of the data that we've seen since the pandemic. And so to your point, Ian, about the yield highs being in for this year, the fact that we now have another month's worth of payrolls data that shows a climbing unemployment rate and another month's worth of inflation data that has confirmed disinflation is continuing apace and at an even faster rate than was expected, all of this points to another potential reason to stay sidelined that has now passed. We've heard it in a version of the same conversation with a variety of clients in that, yes, the curve is going to steepen as the first cut approaches, and yes, a dip buying bias in treasuries is probably appropriate given that we know the Fed isn't going to hike again, but before that happens, we just want a little more information that confirms a minimal risk that inflation is reaccelerating, and that's exactly what we got this past week. So while there's been a lot of wait and see for the next inflation report, now we have another inflation report out of the way, and so that's one less reason to wait and see before buying treasuries.
And now there will certainly be a contingent in the market who focuses on core PCE, although with a combination of CPI and PPI, the market tends to have a very accurate estimate of where the Fed's preferred gauge of inflation will print. That being said, and in keeping with the observation that you made earlier, Ben, about the market repricing and then treading water between major data events, one would be remiss not to acknowledge that core PCE is certainly on the radar, if for no other reason than it will confirm that the moderation of inflation during the second quarter undid some of the uncertainty triggered in Q1. It's also not wasted on us that the lackluster performance of consumption during the first quarter has been rolled forward to Q2, and as consumers become increasingly strained by higher prices, real growth will eventually come under pressure. The one missing component has been a spike in the unemployment rate, although, as we saw with the June payrolls print, there are certainly plenty of reasons to begin being somewhat nervous, if not outright concerned, about the trajectory in the labor market.
And in many ways, this was sort of the messaging that we heard Powell deliver in his congressional testimony this week. We've moved along the continuum of risks this cycle, which initially started with a very heavy focus on containing inflation at all costs, over towards some encouragement on fighting inflation. And now the message from the chair is unequivocal that the risks are now two-sided. And even within the official text of Powell's speech to Congress this week, the idea that the Fed knows inflation is not the only risk they face is a tacit acknowledgement to some of the softening we've seen in the labor market, and is the Fed's way of signaling that the real economy has developed in such a way that it's now appropriate to tilt a bit more dovish and acknowledge what's happening in terms of hiring. So if we think about that continuum from solely concerned about inflation to two-sided risks to solely concerned about the labor market, I would argue we're in the process of moving from concerned about two-sided risks toward a more asymmetric worry about the labor market. And as we watch the incoming Fed speak ahead of the July meeting, that's going to be a theme to keep an eye out for.
It most certainly will, as will the August 2nd release of July's non-farm payrolls print. I suspect that if there is going to be any wholesale shift towards focusing primarily on the employment aspect of the dual mandate, it will need more confirmation from the BLS data. The JOLTS quits rate and elevated initial jobless claims won't be sufficient to convince the market that the Fed really does need to move beyond the inflation issue and begin to worry about the pace of hiring. One dynamic in the market that remains a focus for both monetary policymakers as well as market participants is the continued easy level of financial conditions, as evidenced by equity prices continuing to reach record highs. This had, at least ostensibly, created an issue for the Fed, as it appeared that the market was easing while the Fed was attempting to tighten. Confirmation that monetary policy is once again working to contain inflationary pressures should offset the market's concern that easier financial conditions will be an inhibition for the Fed to begin cutting rates.
And an aspect of that dynamic that's worth exploring is the fact that the influence of higher rates on the household level are not felt equally across different households. For example, lower income quartiles for whom car payments, student loan payments, credit card payments are a meaningful share of each month's take-home pay, that's going to have a much different impact on consumer confidence and on consumption than, say, a household that is participating in real estate appreciation, equities at all-time highs, as you touched on, Ian, and even savings account and money market funds that yield 5% or better. All of that is a version of the fact that financial conditions are still quite easy, even as monetary policy is still quite tight. And the argument can be made that the driver of what will ultimately be the first cut of this cycle is going to be the pain felt among those lower income households, not due to the higher ones.
And this has created an interesting setup for the election in November. As we've seen, the market has been content to trade an improved probability of a Trump victory as a bear steepener, the assumption being that it will lead to more on the fiscal side with the same amount, if not more, deficit borrowing, which would subsequently require the Treasury Department to issue more longer-dated bonds. Now, as we think about the next several months and all of the potential political outcomes, it's difficult not to assume that there will be pockets of acute uncertainty. And whether those moments of uncertainty are characterized by a steeper or flatter yield curve will likely be a function of how risk assets perform, whether or not there's a flight to quality or flight to liquidity bid, and the nuances of the timing versus the September 18th FOMC meeting. If nothing else, we're unlikely to see the ever-elusive summer doldrums, at least not for the next few weeks.
And it wasn't only the inflation data that we learned about this week, but Treasury auctions were again topical, and despite one of last year's unifying themes being supply angst given the size of the deficit, it's becoming increasingly evident based on the auction results we've seen that maybe the demand side of the equation should get a little bit more focus.
So indirectly what we learned is yields don't get high off of bond supply.
And the prevailing theme in the primary market for treasuries over the last month or so remains of elevated non-dealer participation, as the non-dealer allocations have largely come in solidly above the 6-month averages, and a driving force behind all of the stop-throughs that we've been seeing. Now, this week on the eve of CPI Day, the 10-year auction stopped through by 1 basis point and featured the highest non-dealer allocation at a reopening auction in over 2.5 years. The results of the auction speak to the durability of the demand for treasuries in the context of the recent politically inspired bear steepening and angst around the need for higher term premium in the long end of the curve.
The conversation about positive term premium in a more durable fashion is interesting because when we look at historically, there's a very high correlation between the shape of the yield curve and the measures of positive term premium. And it goes without saying, as soon as the Fed starts cutting, the yield curve should return back into positive territory, and with it, significantly increased term premium. So one way or another, whether it's through the Fed's action or the Treasury Department's need to borrow more in 2025, one should anticipate positive term premium during the next part of the cycle. So on the topic of premium, Vail, how would you rank this podcast?
5 stars, no question.
In the week ahead, the economic data of relevance drops off precipitously, and we expect that it will be one of the first weeks that truly feels like the summer doldrums, with 5 full trading days. We do see retail sales for the month of June, and given the trajectory of consumption recently, we wouldn't be surprised to see a bit more softness that reinforces the concern of market participants that there's something greater afoot in the pace of consumption as opposed to simply slow and steady spending over the summer months. This will also be the last week to hear from monetary policymakers before they enter the pre-meeting period of FOMC radio silence. If, in fact, the July meeting should be considered more at play than we think it is, in terms of a potential rate cut, then the Fed would need to be very consistent in their messaging in the week ahead. That being said, we don't think that a July cut is on the table, although current market pricing suggests it's not a zero probability. On the supply front, we see 13 billion 20 years auctioned on Wednesday afternoon, as well as 19 billion 10-year tips. In light of how well coupon auctions have performed recently, we're optimistic about the 20-year, although the deceleration of inflation does bring into question the value of inflation protection in the 10-year tips. The broader price action we anticipate will be a combination of a period of consolidation following the post-CPI repricing and a drift lower in rates as a function of investors becoming increasingly comfortable with the notion that the next move will be a cut, the cut will be in September, and that will mark the beginning of a series of cuts. Now, it follows intuitively that the next debate will be, is the Fed poised to deliver 3 or 4 25 basis point rate cuts, or will they deliver quarterly cuts until the policy rate is at neutral, which, according to the SEP, is roughly 275. Now, for the time being, the market is content with the pricing in of something comparable to what we saw in the mid-90s, which was lowering rates from very restrictive to still restrictive, and then a pause to reassess how the economy is performing, with an emphasis on the inflation profile. Moving beyond that, and pricing in a more aggressive cutting campaign would benefit from further softness in retail sales, from a surprising increase in the initial jobless claims figures, or perhaps more realistically, an acknowledgement by Powell and the FOMC at the July meeting that there's growing concerns about what's transpiring in the labor market. It's certainly too soon to justify cutting rates at this moment, given how low the unemployment rate is. However, if the momentum to the downside begins to accelerate, the Fed could very quickly find justification for lower rates in both the inflation and the employment side, which would trigger a more dramatic re-steepening, as it would imply a risk of more than simply fine-tuning rate cuts. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And with only 3 weeks left to vote in this year's Institutional Investor Survey, we are also looking forward to the end of the telethon. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.